Spanish compliant bonds, an excellent investment platform, tax and succession planning tool for residents of Spain. These days, many people are dissatisfied with the rates of interest offered by their bank and simply want their money to work harder for them. We know the long-term damage inflation can do to the real value of your money over time. So investing your capital can be a solid solution to this issue. Spanish compliant bonds are a popular choice for savvy investors wishing to take advantage of the tax benefits these platforms provide. So how do they work? Well, they are unit-linked policies provided by international life assurance companies. They act as a wrapper, shielding your investments from the eroding effects of annual capital gains tax deductions. So whilst your investments remain inside the bond, that tax is deferred. Why is this important? Well, just like interest, it's all about compounding. And that compound growth effect will be exponentially greater if no tax is taken year on year. Now, of course, it doesn't mean that tax is never paid, it's just deferred until withdrawals are made. But here, another benefit of Spanish compliant bonds comes into effect. When a policyholder takes an income payment or lump sum from the bond, they can benefit from something called proportional tax relief. This is because the Spanish tax authorities see part of that payment as being the original capital you invested. Let's use an example to explain this in a little more detail. We'll say our client, Mrs. Smith, invests €500,000, pounds or US dollars, into the Spanish compliant portfolio bond, and that over time her investment grows to $750,000. So seeing this gain, she decides to take out a lump sum of $150,000, but instead of paying the full capital gains or savings income tax on that amount, the tax authority proportionalize it against her original $500,000, like this. They see the current bond value as being 2/3 her capital and 1/3 growth. Therefore, they will apply this to her withdrawal and only tax 1/3 of her $150,000, so $50,000. How is that $50,000 taxed? Well, investment income falls under the savings tax regime, with the first band of up to $6,000 at 19%, the second band up to $50,000 at 21%, and the third band of over $50,000 at 23%. In this case, Mrs. Smith would pay €10,380, or 6.9% on her $150,000 withdrawal, a lot better than paying tax on the whole withdrawal, which would have resulted in a liability of €33,380. There are also other benefits with this type of investing in terms of estate and succession planning. Firstly, if a policy is set up in joint names, typically but not necessarily spouses, then upon the death of the first policyholder, 100% of the ownership rights pass to the surviving policyholder without exposure to inheritance tax in Spain. Furthermore, for some people, it's very important to plan and make sure their assets are passed safely onto whom they wish after their death. To this end, the bond allows policyholders to name beneficiaries at outset, including what percentages they will receive. This means that proceeds from the policy can be immediately paid to beneficiaries without the need for an often lengthy and expensive Spanish probate process. Now finally, and just as important as the tax benefits, are the underlying investments. We build for you a bespoke portfolio taking into account your personal goals and preferences and, importantly, your attitude to risk, which we ascertain early in the client onboarding process. Our priority is the protection of clients' capital and providing the high levels of service that you would expect from a large international advisory group. Of course, we hold all the appropriate licenses and authorizations to give qualified advice in Spain. Thanks for taking the time to watch this video on Spanish compliant bonds, and please give us a call if you'd like further information. So until the next time, it's bye from me.